Hello, everyone, and welcome to the June Market Compass. It's hard to believe we're now squarely in the middle of 2023, looking out to the second half of the year. Now, what I thought I'd do first is recap some of the themes that have played out in markets so far, and then I'll talk about three themes for the back half of the year, including number one, a cooling in economic growth and inflation. Number two, the Federal Reserve potentially stepping to the sidelines on rate hikes. And number three, the opportunities we see forming in both equities and bonds. So first, two trends to highlight in equity and bond markets this year. Number one, while equity markets have moved higher, leadership has been narrow. As you can see from this chart, while the S&P 500 overall is up over 13% this year, only three sectors, technology, communication services, and consumer discretionary, have outperformed the broader index. Now, these three sectors are up over 25% year to date, while the remaining eight sectors are up modestly, flat, or even down for the year. Now, while it's certainly welcome to see positive returns this year, in our view, broader leadership is a healthier sign for markets, and we would actually expect this to occur as we head into the back half of 2023. Now, second, unlike stock market returns, bond market returns have been somewhat more muted thus far. Rates continue to move higher, pushing bond prices lower. In fact, the Barclays U.S. Aggregate Bond Index is up just about 2% this year. As you can see from this chart, 2-year and 10-year U.S. Treasury yields have moved higher in the past few months, as expectations for Federal Reserve rate hikes continue to climb as well. Now, this has put some pressure on bond returns near term, but we would expect yields to be peaking in the months ahead. We'll discuss this more in our themes for the second half. So given this backdrop in equity and bond markets, what are the key themes we see for the back half of 2023? We'll highlight three. First, we continue to see signs that the U.S. economy may continue to soften, and potentially a mild recession may emerge in the back half of the year. However, we still do not expect any downturn to be deep or prolonged, and in fact, we may ultimately see this downturn manifest as a slowing in growth to below trend levels of about 1.5% here in the US. Now, we also believe that inflation will continue to moderate as the year progresses. Keep in mind, both the Consumer Price Index and Producer Price Index inflation metrics for the month of May have come in lower than expectations, especially on a headline basis. And we've seen now the 11th consecutive lower reading since inflation peaked back in June of 2022. Now, our view is that inflation should continue to moderate, likely heading towards about 3% on a headline basis by year end. And what factors do we look at that support this view? Well, here are a few forward-looking indicators to highlight. First, ISM prices paid indexes for both manufacturing and services have moved lower. Next, global supply chain pressure indexes have eased and actually are now back to pre-pandemic levels. Home and rental price appreciation has moderated, which tends to show up with a lag in the inflation metrics. And finally, labor markets have been solid, but some early signs of cooling have emerged, including rising jobless claims and a lower total number of job openings. Now, the second theme for the back half of this year is that the Federal Reserve will likely pause its interest rate hiking cycle. As you can see from this chart, the Fed's estimate of its terminal or peak Fed funds rate has climbed higher since really March of 2022. The latest set of estimates by the Fed indicate that the peak Fed funds rate may now be close to 5.6%, which implies about 2 more rate hikes from here. However, we believe the Fed will be data dependent. They will pay close attention to the incoming economic and inflation data, and if those data don't warrant 2 additional rate hikes, they may not implement these. But more broadly, we do believe that overall the Fed is nearing the end of its tightening campaign. Now, while rate cuts are not likely this year, a pause in rate hikes will be welcomed by markets, especially if this is because inflation has moved closer to that 2% target range. Finally, the third theme for the second half of 2023, the opportunities we see forming in both stocks and bonds. Now, in equities, we would look for broader participation in leadership, particularly as investors look towards 2024. We think that could bring lower inflation, lower interest rates, and better earning trends overall. Leadership could include small cap stocks, cyclical sectors such as industrials, materials, consumer discretionary, alongside the AI and technology themes. Now, in bonds, we see an opportunity to complement some of the short duration bonds and cash like instruments with longer duration bonds, particularly in the investment grade space. Now, keep in mind that the peak in Treasury yields typically occurs 1 to 2 months prior to the peak in the Fed funds rate. This could imply that peak yields are likely perhaps in the weeks ahead. This would present an opportunity for longer duration assets, as investors can not only capture better yields, but also have the potential for price appreciation as the Fed pauses and ultimately pivots lower. So with that, hopefully we've given you some good food for thought on the themes and opportunities for the second half of 2023, and we'll see you back here for the July Market Compass.